So we've been talking about variance analyses for direct costs and sales volumes and things of that nature. Now we'll talk about it in relationship to indirect costs. As we said before, there are two purposes for variance analyses. One, which is product costing, which is an accounting purpose, and the other is for control, which is a management purpose. Overhead is really, taking fixed overhead is really a product costing purpose. We'll talk about the variances again. We'll talk about service organizations, managing variances, and managing standard costs in service organizations. And then we'll just have a very brief discussion of when should you dig in and when should you dig in on variance analysis, investigate costs. Back to our anchor slide. This is really talking about overhead, whether it's variable overhead or fixed overhead, and decomposing the causes of overhead. It's a little bit different. That's why we have a whole separate chapter for it in this text. So what really are the components of variable and fixed overhead? Variable overhead, things like energy costs, indirect materials, indirect labor, equipment repair and maintenance. These will vary based upon the volume of sales and the volume of production. They won't be fixed. The more you use equipment, the more likely it is to need repair. The more you use equipment, the more energy you're going to use. So clearly it's not purely fixed overhead. Fixed overhead are things like salaries of factory floor manager, depreciation, security guards, you need security guards whether or not you're selling a lot or not, taxes, etc. These, no matter what your volume is, within a relevant range, should stay fixed. As a general rule, although clearly not always, and I think clearly not in an example we're about to do, variable overhead should be dwarfed by fixed overhead. Fixed overhead should be a lot higher. Generally speaking, I wouldn't say that's always the case. So again, there are two purposes. The first is the control purpose. Just as we talked about, you have to be careful when using variance analysis that are direct for control purposes. You have to be extra careful with overhead, because what's your allocation base? Are you really managing the use of the overhead, or are you managing the use of the allocation basis? If you're basing volume based upon direct labor hours, is it really the problem that you have to make direct labor hours? It has nothing to do with overhead. There should be a clear cause and effect between the driver and the allocation. So whereas you always want to do with care, the key word here is extreme care. When you're trying to make operational decisions off of this variance analysis, use extreme care. Now for product costing, if you're using a standard costing system, this is really why you do it. Because at the end of the day, you need to do something called absorption costing, which says that all your fixed costs need to be included per unit and allocated to each of your products. And so if you're using a standard costing system based upon standards early on, we need to somehow allocate any differences from standard to the individual units. Or, actually, what you don't do is to the individual units, you do it to the broad category of cost of goods sold or inventory. And we'll get to that in the chapter. Use a slightly different term here. We don't use favorable and unfavorable, we use over or under applied. Over or under applied. So you over apply your fixed costs if your standards prove to be higher than your actuals. So you estimated your fixed costs to be higher than your actual, and so you've been allocating that to each of your units more than you should have. You over-applied it, and you need to fix that. If your standards prove to be less than your actual, you under-applied, and you need to apply more of the costs to your cost of goods sold. So it's we treat it similarly to favorable and unfavorable, but because it's less of a management tool, we call it over or under applied. And we have to do this for proper product costing because it's the law. Okay, so let's first talk about variable overhead. This will feel a lot more similar to what we've been doing. Variable overhead. Now it's driven by cost driver, but you're doing the same analysis of spending and efficiency variances that we've been doing. So this is variable overhead variance analysis. So the components are, there's a spending variance, and that's the differential times the actual quantity. Your standard overhead rate versus your actual. We'll talk about these overhead rates in a moment. And then there's the efficiency rating, which is just based upon your quantity of use. Okay, let's do it with an example. Schmidt Machinery applies variable factory overhead on the basis of direct labor hours. Here's their standard. They applied 5 standard direct labor hours per unit, so at a standard variable overhead rate of $12 per direct labor hours. So what's their standard variable overhead rate per unit sold?
$2.4.
$2.40.
Other direction. 60. It's $12 per hour, and you have 5 hours.
Yeah.
In October, they worked 35 10 hours to make 780 units, and $40,630 was spent on variable overhead. This is background. Let's go back to that standard cost sheet that I showed you at the very beginning of the discussion of Chapter 14. And it shows you that your variable factory overhead is 5 hours per unit at a cost of $12 per hour. So your variable overhead is $60 per unit sold. Here's how you do the analysis. In that month, there were 3,510 direct labor hours that was given. You can calculate your actual rate, but they said that $40,230 was spent on direct labor, and you had 3,510. That's your rate, less than the $12 an hour rate, which is equal to the $40,630 that we already knew about. So we just done this kind of decompose. We had this number and this number, and came up with the rate. Okay, standards. And here's where it gets a little tricky. We use the actual units sold here. We didn't use 1,000. 780. 780. Okay? So our standard hours is based upon the standard of 5 direct labor hours per unit, but we're not using the standard number of units, we're using the actual number of units here, 780. That's the tricky point right here. So now you have the direct labor hours, standard times the standard rate of $12 an hour. Now we had 46,800. Why do we use the actual? Because if we use the standard, then we have not. It doesn't give you a good point of comparison. For the purposes of allocating out the variable overhead, if you would have used the standard here and the actual number of units here, there's just like you have to go multiple steps here, with multiple decompositions to break it out and understand what's going on. So this allows us to understand and compare apples to apples a little better. Because these actual hours are based upon producing for 780. Then you flex it in the middle. You use your actual hours and maintain your standard. And you see, you can break it down to your spending variance and your efficiency variance. So the tricky thing on doing these is, one, remember that there are a number of hours per unit that matter, and that you're going to be using the actual number of units even for your standard. Okay. Mathematically, you could use this. Yeah, did you have a question?
So just conceptually, so the column on the right, the 4680, that tells you well, we don't know how many units they have projected to make, right?
Well, it's because it's a continuation of the example. Chapter 14, we know it was 1,000.
Oh, it was.
Okay. It's a continuation of that.
So this tells you that even though they only made 220 units fewer, still they made them more efficiently. Because it's a positive efficiency variance.
Made it more efficiently and at a lower cost here per unit. Because they used direct labor hours slightly below budget. 1157 rather than $12 per unit. See if both of those were favorable. Right, we're honing in on exactly. I mean, remember, if you use the 1,000 here units, it's just one. You have to go one more variable over to use the 1,000. Because here you're trying to compare how well you did first efficiency in using your direct labor. Assuming direct labor hours is a good judge for overhead, the efficiency of that. And then you want to look at the rate differential if you use the standard units, you'd have to first compare the standard units to this, and then this. So you could do that, and it would tell you that because you sold less, you used less variable overhead related to the fact you sold less.
What if we have a predicate unit instead of the extra the unit? Can you use the predicate unit to calculate those and start rate?
Use which unit? I'm sorry.
Just a predicate.
Predicted unit.
Unit. What if we have a predicate unit? Can you use the predicate unit?
No, again, we do know the predicted unit, so it's 1,000. Because it's the same example as chapter 14. Well, we kind of do because we remember it from chapter 14.
Yeah.
It's the same example. So, but you don't use the predicted units. Use the actual unit sold because you want to isolate a variable. If you use the predicted units, then you have two variables in there: a change in the unit sold and potentially a change in the hours used per unit to sell the complete unit. We want to isolate one variable, which is the hours per unit. That's the efficiency variance we're looking for here. It doesn't only look for right, because that's otherwise we have two variables in there and they kind of get lost in each other. Yes.
Oh, that's okay. It took 3,710 hours, right? 780 units, which is 450, 4.5 hours per unit, whereas we had projected to spend 5 hours.
Right.
So where's that? Where's that potential? 450 versus 5.
That's where you're getting right here.
And where is that? But where's like the 415 white versus 5 in these numbers? Like, you know what I'm saying?
Let's see what's here.
Okay, so
It's these two numbers right here. So that 390 direct labor hours, right? 10% more efficient. It's the right analysis, but that's where that difference shows up. It shows up right here. And that's where that favorable variance comes from. Okay, how do you interpret variable overhead variances? The spending variance. In this case, 1490 favorable. That's one that you can actually do something with. You spent more or less than you expected to spend for the overhead items. So, supplies and utilities. So those items, that spending variance is something you might want to look into if it's material. The efficiency variance, so this other one, the one's giving us more trouble. There's not much you could do with it. Not much you should try to do with it, because it's about the efficiency in using direct labor hours. As you said, they use 390 fewer direct labor hours to produce the same thing. That's great, but that's not really an analysis of overhead. That's an analysis of how well you use your direct labor hours, and that's where you should focus that analysis. It manifests itself here, because that's what you're using as your cost driver. But there's really not much you can do with that in terms of how are you going to manage your overhead then. So you could use the spending variance, but not use the efficiency variance. Variable. A fixed overhead, different animal. Good news is the calculation is easy. Bad news is maybe a little bit more confusing. Easier to do, harder to understand. actual fixed overhead will be given. I think it was 160,450, whatever it was. Fixed overhead budget was given. New animal here, fixed overhead applied. This is where you under apply or over apply for cost accounting purposes, for accounting purposes. You might be able to use this spending variance in the same way you might be able to use it on the variable overhead side for control purposes, although it's a little bit obscure. This volume variance has only one purpose, and that's for getting your cost out, to make sure if you've over or under applied that you get that application right. How do we calculate it? Determine the budget, the fixed overhead for the period. Let's say it's 150,000. We determine an activity variable, cost driver, for applying that fixed overhead to outputs. Let's say it's direct labor hours. It'll be different for different companies. You choose a denominator volume level for the selected activity variable. For instance, practical capacity. We talked about practical capacity. Remember that? Anybody remember practical capacity? That's kind of how much you can really expect at full utilization. Full utilization is not necessarily 100% utilization. Because if you think about people, it's you have vacation, you have overtime, you have sick time, etc. So it's not necessarily 100% capacity. For GAAP purposes, you're supposed to use something called normal capacity. Normal capacity, which is your expected level of capacity for a reasonable medium-term time horizon of 3 to 5 years. Still plenty of room for management here. And we'll talk briefly at the end about how the use of this denominator can affect your statements, and it could be used for management purposes to make your year look better or worse. So this is an area of some concern, accounting concern. So you have this denominator, you have your numerator, which is your total budgeted factory overhead. You divide the two, and that's your standard factory overhead application rate. And that's used for product costing. So as you're producing product, you can apply your overhead to the product. And hopefully you do it well. So at the end of the year, very little overhead variance. If there's some overhead variance, you have to take care of it at the end of the year. Okay, let's go back to our favorite Schmidt Company example. 120,000 to 150,000. 120,000 is the budget. It's based upon now, beginning of the year, we budgeted, just to confuse us, 1,000 units, remember? Not the 780. At the beginning of the year, you budgeted 1,000 units, and you said it was going to take 5 direct labor hours per unit, assuming practical capacity. You know that the actual production was 780 units, and we actually also know that fixed overhead was over budget 130,650. So let's now compute the fixed overhead spending and volume variances. First thing you do is you compute the application rate. You take your budgeted overhead and divide it by 5,000 direct labor hours. That's the beginning of the year now. So at the beginning of the year, we want to figure out how much are we going to apply for every time we sell a product. So you have to use the 1,000 for this. At the beginning of the year, you don't know that you're going to only sell 780. using 500 or 5,000. You're selling 1,000 units at 5 direct labor hours per unit. And so every time you sell a unit, you have to apply $24 per direct labor hour. And if you assume the 5 direct labor hours, that's $120. So $120 per unit sold is going to be application of your fixed overhead. If you made this a different number, what's going to happen? We said if you're getting the instead of only 800, what happens to your
Goes up.
up? Right? So if you lower your budget, you increase the amount of money you're going to apply per unit. Increase your costs, reduce your profits. And if you lower this number, what happens?
It's going to go down.
Goes down, and you can actually have more costs. So through the year. I'm sorry? That's your standard fixed factory overhead application rate. So it's your fixed application rate. Fixed overhead application rate. Okay? This is that same chart. This is a given standard. This is that application rate we just calculated, $24 per. So you extend them, you get $120, and I fix that. So remember, that was at the beginning of the year. Now the year is happening. You only sold 780 units. You kept your standard hours per unit, and you kept your standard dollars per hour. Calculation becomes pretty straightforward. These two numbers are generally going to be given to you. Your budget and what you actually spent. This 10,650 over is something worth looking at. Why, that you can try to manage. Why was it higher? Why was your fixed overhead higher than your expected budget? This differential here is only for the purposes of applying your fixed overhead. Think about it. Every time you sold a unit, you're applying a piece of the fixed overhead to that unit. 780 units were sold. But since you're thinking you're going to sell 1,000, you haven't gotten rid of all of that fixed overhead. There's still 26,400 that's underapplied. Has not been allocated out to your products. So at the end of the year, when all is said and done, you have to get this out into your costs. Make sense at all? Explain this again. This part right here. Okay. At the beginning of the year, you budgeted 120,000 fixed overhead. So you've calculated that every time you sell a unit in the course of the year, $120 is going to be taken from fixed overhead and considered to be part of that unit for accounting purposes. It's part of the cost of that unit. Okay? When you sold less than you said you were going to sell, but you still said you're going to have 120 budgeted. So you have not allocated out all of your budgeted overhead. There's 26,400, which represents the 220 units you didn't sell times these standards, that needs to be applied out somehow. This is not about meeting budget now. This side of the equation has nothing to do with control purposes, meeting budgets, but you ultimately want to apply the entire budget to products. That's right. Otherwise, you can do a lot of management here. Just really, make huge budgets, under-apply it, and your costs will look much better, so look higher. Although from a tax perspective, I mean that's going to be better.
Basically, because it's a less mixed budget, we have 20% left over of fixed costs.
Fixed costs that you've not allocated out, you've not applied to product. That's exactly right. If you visualize your ledgers, it's $26,000 in fixed overhead costs that haven't found their way to the ledgers.
So another way of looking at this, that your fully 780 would stay in costs that it would have to have spent with 1,000. Actually, the actual cost of each unit you did for is actually higher. The fixed cost of that unit were higher than.
Yes, exactly. Exactly right. Think of that. Right now we're forgetting about this stuff over here.
Right.
But fixed costs are fixed costs. They don't change with volume. You were guessing how much you were going to apply to each unit at the beginning of the year. You undersold, so therefore you have to apply more. That's all it's going to say.
When you start with the last chapter, the actual fixed overhead was to be applied or actual fixed cost?
Last chapter was not about applied.
Okay, so the actual fixed cost overhead.
This is actuals. Yeah, this is how much. These are the checks you had to write. Okay. So far, we're only talking about this. We've also actually underapplied by this amount. Right? At the end of the year, you realize you spent $10,000 more than you should have. That's also a problem. Oh, so you were thinking about both? Yeah. They're both underapplies, right? You underapplied here as well, because you're only assuming you're going to spend $120,000. It'll be easy to calculate. So your total underapplied is now what you were thinking about, the actual amount you spent versus what you applied. And it's broken down into two components. This is the one you can manage. You spent more than you budgeted. Why? Where'd that $10,000 come from? This you're not using for management purposes. This you're just saying, well, we sold less than we should have. Let's make sure we get that applied to our product. Okay?
But the other one you can't really control because you can't control the fixed cost.
Somebody could probably control it.
That you can control, but the other
This one is just all about volume differences, right? In this case, it was all you sold less. You have to apply more to per product because you sold less. Just another way to do the same thing. Okay, a really super simplified example. Okay, so calculate these three numbers. You know that the applied amount was $122,000. The budgeted amount was $120,000. The actual overhead incurred is $140,000. Calculate your variances. Okay, what is the total fixed overhead variance? How much?
17,000.
Over or under?
Under.
Under applied by 17,000. How about the production volume variance?
That's over applied by
3,000.
Over applied by 3,000.
Yeah.
How about the budget variance?
20,000.
20,000 under.
Yeah.
What's the budget variance tell us? In words, generally speaking. Yeah, somehow they did a good job of managing their overhead or something, because they made their actual overhead. No, not a good job. Excuse me.
Right.
The other way. So they did a bad job. They were 20,000 over budget. What does the production volume variance tell us? Produce. Okay, so as we talked about, what does this all tell us? The budget variance. That results from spending more or less than expected on fixed overhead. And that's worth looking into. The production volume variance just tells us we operate at a different level than our denominator volume tells us we should be operating at. And it doesn't tell us much of anything except we need to go ahead and figure out how to define it for accounting purposes. Causes of fixed overhead variance. Maybe it was a bad budget. Maybe we didn't control our costs as well as we should have. Maybe items were classified, another bad budget, they classified as costs that are fixed rather than variable. So things you could try to manage, but it's not clear exactly what they would be. Production volume variance, that's due to market change. So it's nothing to do with your overhead. Let's come back to this. This time. So if we took everything we know about Schmidt, we could show we had a net effect of being $30,000 under, $37,000 under. All of the variances come together.
So the U here is extrapolate the aggregate of the overhead and the other that's unfavorable, completely underapplied.
That's unfavorable. Exactly. Favorable and unfavorable. It's the one item. Yes, really these two items are the underapplied. Plus the minus. Okay. If your underapplied or overapplied is relatively immaterial, you close it out solely as cost of goods sold and call it a day. do it at the end of the year, not at the end of each month. You don't try to juggle it each month. Okay. It's not. By each entry, you mean? It's not about each. You have to put it to each specific cell for accounting purposes. You have to put it for the total of the product line, right? You have to put it. You have to be able to build your tax statement. So it's not about each individual cell. You have to put it towards. It just has to be total at the end. And so, now to me, 37,000 is reasonably material. So you can do it this way for this material. What you're showing it here. A better way to do it, more exactly way to do it, is allocated between inventory and cost of goods sold. It'll allow you to have more reasonable results. In theory, you should be doing it towards 5 accounts, but it's fine to do it between the 2 accounts. Finished goods inventory and cost of goods sold. So management can play with this denominator to create results they want. And without getting into too much detail on this, it's hard to talk about it, it's hard to understand. But if you are in a world of increasing inventory, so your inventory levels are going up, if you lower the denominator value, what happens when you lower the denominator value?
The cost of goods.
So you apply more during the year. The higher rate. So you increase what you're absorbing through the year, maybe even over-absorb. That will allow you to keep costs in inventory versus having them go to cost of goods sold. And what does that do for you? And so you kind of bulk up the balance sheet, and you have a better looking expense because you lower your expenses and bulk up your balance sheet. So management can play with this and create situations that are favorable from an accounting perspective. So managing earnings is not a good thing. The service industry. What's unique about the service industry? The accounting industry, for instance? Not a lot of direct materials, right? It's direct labor based. And also, you think of direct labor in a professional services firm as somewhat fixed. In that, you're not growing and shrinking the labor force on a short-term basis. You're planning the growth, and then you have monthly salaries up that do from time to time go and shrink the labor force. And then your other significant cost behind labor is brick and mortar. So it's a high component in the way they would manage themselves of fixed overhead or fixed costs. So applying that fixed costs is more important. And then then in the airline, shipping, and telecommunications industries, they have big fixed costs, right? They have airplanes and boats and trucks. And in telecom, they have wires all over the world and towers. And so it's a high fixed cost component of that as well. Then let's think about hospitals, another type of service organization. You know, if they should they be using a standard costing system at a hospital? Is there a standard level of care appropriate for a heart attack patient? And would you want to be managed to that level of care? An interesting case recently. There was this soccer player in England, who 23-year-old guy who died on the field. Did you see that? And they took care of him for 90. His heart stopped. He was considered dead for 83 minutes, and brought him back to life. And the question was, he's fine. He's sitting up in bed and all of that. And the question was, would they have done it for any of us? But he had what probably was not a standard level of care. And he hoped that none of us would get a standard level of care. Okay, the variance investigation decisions. This is all variance now, not just what we're talking about in chapter 2. When should you investigate a variance? Well, the first question is it material enough? The size. Is it immaterial? Don't worry about it. Is it recurring? Because if it's recurring, then it's something you need to be thinking about. How do you get rid of that variance? Why do you always have the same variance year after year, period after period? Is there a trend? Do you see something getting worse and worse by period? An example of the trend might be machinery that's getting old and maybe isn't working as well as it used to, causing variances that you see getting worse and worse and worse. And so you need to see that trend and understand, even if it's been within a relevant range and it's been okay for a while, it starts to go outside that range continually. That's a red flag you should look for. I'll talk about this on the next slide, but is it a controllable variance? Some variances, they just happen. You don't spend too much time investigating something that gets out of your control. It's caused like some random thing out there. What do you guys think? Should you investigate favorable variances? Yes. Okay, good. Why? Okay, that's good. Could be fraud. Could be a favorable variance in direct materials that's killing your direct labor because you're using lower quality materials. So even favorable variances need to be understood. And then, as in all things, what's the cost of investigation? Right? You can spend more on investigating than any variance itself. So random errors. Let's say there was a flu epidemic, there was a building fire, caused variances. Okay, don't spend too much time on that. Prediction errors. So you're creating your standards, you're creating your prediction, and you made a mistake in those. You want to understand that process. So you do want to investigate those. So understand the prediction process. Same thing for modeling errors. If your model is wrong, maybe you didn't consider a learning curve. Maybe you accounted for things in the wrong way. Fix that. But the real one we're talking about are implementation errors. Something went wrong. You bought too much. You were inefficient in the factory, and you didn't train your personnel right, whatever that case may be. That's the one we're doing.